Welcome back to our channel. Today, we are talking about top 10 beginner investing mistakes. But before we get started, subscribe to our channel to never miss a stock update.
In an ever-changing world, you have to adapt. And cryptocurrency is taking the world by storm. It's the most efficient and secure payment method in the modern world. Coinbase makes it easy to start your own cryptocurrency profile, and you can get started in less than a few minutes. Invest in us to invest in the future.
So without further delay, let's get started. In recent years, interest in stock investment has been increasing due to the tax exemption systems such as NISA and the rise in stock prices due to the effects of Abenomics. However, beginners in equity investment often make mistakes. Here are 10 mistakes that beginners tend to make when investing in stocks. Mistake number 1. Jump to the high price, throw at the low price. It's the worst. If the stock price rises before you can buy the stock you want to buy, it will jump to a high price. The frustration of not being able to buy can boost the action of buying. On the contrary, the impatience that was not thrown due to the fall in stock prices calls for a throw. As a result, you buy it on a ceiling and sell it on the bottom. What on earth do you want to do? Why are you so impatient? You should cool your head. Although it can be avoided if there is an early action, it is necessary to assume the limit range of the market in advance in order not to grab the ceiling or sell the bottom. If you are impatient with your investment, you lose. A calm analysis is always needed. Mistake number 2. The investment index is viewed as universal. It is dangerous to judge only by the index. There are endless investment indicators such as per price earnings ratio, price to book value ratio, and return on equity, but none of them are universal. Financial statements change, and expectations change as the company's reality and environment change. Even if the investment indicators are the same, handicaps are depending on the size and industry of the company. Different industries have different exposures to the external environment, and smaller companies have relatively less risk diversification than larger companies. It should also be noted that there is a tendency for cheaper indicators to continue because better indicators are expected as sales and profits change easily. It is safe to think of investment indicators as a guide only. Mistake number 3. Belief in technical indicators too much. Don't make a fool of yourself. There are many technical indicators, and many paid sites and software offer their tools. Technical indicators look very correct when viewed later, but trend-based progressive indicators are often delayed in the actual market. On the other hand, the reversal type index, the contrast type, does not work well when the market trend appears. It is better to think that there is no universal technical index for both trend and reversal systems. However, it is also true that technical indicators are a good representation of the supply and demand of the market as a result. It is not good to believe too much, but you do not have to make a fool of yourself. It is safe to think of this as a guide only. Mistake number 4. Don't look at basic information. There are various common criteria for measuring the value of stocks and bonds, and it's easy to decide when to buy or not. Do a thorough preliminary survey and pay attention to basic information such as profit growth rate, trading margin, and potential for increased sales. Mistake number 5. Investing everything in one thing. Many people are distracted by short-term investments and are only aware of their position, security holdings. Some investors believe that focusing on just one stock will yield greater returns when stock prices rise. However, if the position does not move as desired, it can be a loss. In another word, diversified investment should be done. The profit is immediately fixed even though the unrealized loss is closed. It often happens when a stock price trend appears, but there is the same amount of profit and loss. The profit can be realized without hesitation, but the loss cannot be cut and further expands. I even try to forget that I'm losing. Those who cannot take what is happening in front of them as a fact are not suitable for stock investment. No matter how much you deny, the loss is loss. I want to consciously bias the loss as soon as possible and endure the profit taking as much as possible. Mistake number 6. A person who inflates an image that suits him. I collect information about my stock, but I unknowingly turn my back on negative information and only collect positive information. Therefore, even if the stock price is falling, I think it is more correct to hold onto it. But do you think that this is profitable? Love is said to be blind, but the stock investment is the same. Do you understand all of the listed companies? Are you unknowingly inflating an image that suits you? People with stalking qualities are not suitable for stock investment. Rather than just waiting for the rebound of the stocks we hold, we would like to consider the possibility of switching to other promising stocks and achieving results. Mistake number 7. Affordability. People who stick to past prices. If you observe the same stock for a long time, you will remember the stock price level you wanted to buy, but you will not be able to get back onto the buying flow when you enter the uptrend. On the contrary, when the stock price falls to the stock price, the risk of further decline is forgotten and it is considered as a buying opportunity. The market price is basically buy cheap and sell high. However, in reality, it happens that the level bought with the assumption that it is cheap is actually expensive. And conversely, the level sold with the assumption that it is high is cheap. Why is that? In another word, change has occurred. This is the reason why the market is called a living thing. Those who do not notice the change, that the previous affordability of cheap and expensive will not work, will end up repeating buy high and sell cheap and inflate the loss steadily. It is better to forget the past stock price when the new news comes out, when the stock price is motivated by the volume, or when the market environment changes. Mistake number 8. Unplanned people shouldn't invest. The worst thing is people who have a margin of 1 million yen and invest all of it in stocks at once. And when the actual loss of 200,000 yen comes out, they are upset compared to their living expenses. Those who do not have such a plan are not suitable for stock investment. When you start investing, first decide the total investment amount. Next, the total investment amount must be used to determine the amount to be allocated to stocks, the amount per issue, and the investment stance. Assuming a loss that can be prepared, consider in advance how much investment amount can be tolerated. One risk diversification is to leave some spare capacity to buy more when the price drops after buying and the feeling of cheapness increases. And it is better to assume how long the investment will continue. The purpose of the investment should be clarified for the total investment amount or for individual stocks, such as whether to aim for short-term price increases, long-term growth potential, or dividend yield. In addition, we would like to consider the appropriate use of accounts, such as NISA, NISA, and the margin trading after understanding the advantages and disadvantages in terms of risk, tax system and cost, and then considering the appropriate use according to the investment purpose. I don't want to jump into specific information such as news and buy or sell. Even if a good article comes out to a company, I want to determine when it will be realized and how much it will contribute to the company's profits. In addition, when a company is selected as a candidate, it is necessary to consider where the risks of that company are, and at the same time, make a multifaceted evaluation, such as comparing with other companies in the same industry. And it is important to keep an eye on whether those evaluation points have changed after the investment and whether they meet the original investment objectives. In addition, corporate actions such as earning amounts, ex-dividends, and stock splits need to be marked in advance. It is better to be able to make assumptions in advance than to cover up the stock price fluctuations. Mistake number 9. Don't try to double your investment at once. When an investor who trades 500 shares in good condition doubles the trading amount, it is better to not double the amount with one investment, but to increase it little by little in several steps. Professionals are cautious when increasing the amount of money they trade. By investing over time, you can explore the situation and reduce risk. Mistake number 10. People who can only imitate are inferior to monkeys. There are also legendary gamblers in the world. We will expand our assets by making concentrated investments regardless of risk diversification. It is certainly backed up by knowledge, but in a sense, it can be said that there is no sense of balance in terms of not hedging funds, and such talents and successful cases are rare. Different people have different personalities and lifestyles. Some people are good at following the trend and keeping up with them, while others are good at contrarian in the box market. Some people can stick to the market while watching the monitor all day, while others have difficulty seeing stocks during trading hours. It is important to learn, but I think it's impossible to see and hear people's success stories and try to do the same thing. So that's all for today's video. Thanks for watching. If you've enjoyed it, make sure to hit the like and subscribe button to our channel. Let us know your thoughts in the comments section. Stay safe out there.